Hey, my friends. Okay, today is part 3 of our series and the final installment of how to trade indicators of indicators. And specifically, we've been looking at the Bollinger Band of the MACD. You can do other combos as well. Wanted to keep it consistent for you today, though, or in this little series. Okay, so now we're going to actually get to how to trade this puppy dog and put on your aluminum foil triangle hats and pull in the vibrations that are coming from me. So here's the trading aspect of it. What we want to do is, and we've got 3 parts here that we're going to be looking at. So I'm going to show you the basic trade first, and then some nuances to it, because there's times when it looks like it works, other times it looks like it's not working, but there are ways to know when it works and when it doesn't for a very, very, very high probability trade. And I'm just giving this to you for free, god darn it. All right, so here's the basic trade. The basic trade is there's your MACD line, the black line. And again, I kept the moving averages up here, the 12 and the 26 moving averages, so you can see those as well. So you can see what's actually happening, what's being represented by the MACD. So what we're looking for is a Bollinger Band expansion. A lot of people call this a Bollinger Band squeeze, and it is coming out of a squeeze, actually. So we've got our little Bollinger Band squeeze down here. Now remember, that means basically the Bollinger Bands are very, very close together. All through here, the Bollinger Bands are very, very tight, right? So that equals, or that indicates low volatility. And by the way, volatility refers to the range of the market. So actually, I'm bringing that up. Very important concept, just to understand the basic concept. So let's say the market's doing this. This is price action now. All right, it's representing price action. That would be low volatility because it has a very narrow range of price action. So the range is from high to low, very narrow. As opposed to volatility can be this, and then high volatility would be something like that. So we get a big move in price, big range, okay, maybe a short retrace, big range in price. So then this would be a high volatility market. So it really, the best way to understand that, I think, is the range of the prices. You can use rectangles like this. I find this one of the most helpful ways to kind of shortcut people's understanding of it. However, another very important concept with volatility is that volatility is not the same as trend. You can have low volatility trends and you can have high volatility trends. Trend is the extended general direction of the market. It's directional. But volatility is not necessarily directional. So you could have a market that, well, let me do it over here. Now I'll do it over here with that. I'm going to cover some price bars, but you could have volatility. Actually, if I grab the arrow, that'd be helpful. That is a wide range volatility market like this, and like that, and like that, and then like that. Okay. So we still got big range, but there's no directional bias, right? We're making higher highs, lower lows, higher highs. So volatile, but not trending. All right. So having said that, now let's go to how to read this, how to actually trade these patterns. So we're looking for an expansion of the volatility. We got a intraday chart here, 2-minute, just because that's what we've been using. So now one of the things to be careful of is at the end of the day and at the beginning of the day, things can go all what us professional, classical, technical analysis geniuses with a capital J, what we call higgly-piggly. So I believe that was the term W.D. Gann used. Not sure. Don't hold me to that. But so the open of the market and the close of the market, things can happen because at the end of the market, you get a lot of people just closing positions. So they're not directional. And then at the open of the very early open of the market, like within the first minute or two, you get a lot of market on open orders, which has nothing to do necessarily with what's going on at that time in the market. And maybe we'll talk about that another time. But let's focus here on the setup. So the setup is we're looking for the Bollinger Bands moving away from each other. That means the upper Bollinger Band is angling up, the lower Bollinger Band is angling down. Now that will be temporary. Don't expect it to keep going down. It's a temporary move. So that now indicates a expanding volatility, not of price necessarily, but of the MACD indicator. Because remember, we're now measuring Bollinger Bands or volatility of this here MACD line. And then we'll relate that to price action later. So this indicates, okay, expansion, and we want to get in as early as possible, by the way. So we really want to see a contraction like this, a Bollinger Band squeeze pattern, and then the first time that breaks out, that's our signal. Professional traders are always in early, amateurs are always in late. It's one of the big distinctions between amateurs and professionals. So we want to look for this first time, not wait too long, because it goes away after a while. Volatility has cycles like anything else. High volatility, low volatility, expansion, contraction. So get in early on this. And so now we see we've got that expansion of volatility, right? So big move of MACD. Now, again, that's going to mean that these two moving averages are moving away from each other. Then we want to see the upper Bollinger or the MACD line touching or going above the upper Bollinger Band. So those are the two criteria to look for the indication of these two lines going to be moving away from each other. All right. So then, now on this one, we get a gap up. So we don't want to chase the market. So in this particular situation, this is why I always say, you can never just trade an indicator. Indicators don't directly make us money. Otherwise, we'd call them money makers. They indicate something else. In other words, they point to something else. They indicate. So this indicates that we've got an expansion of the MACD, the moving average convergence divergence. So since it's early in the morning, we gapped up. In this particular situation, I would wait for a retrace and see how things look there. Retraces right back down to the moving average, holds. Do we still have our signals here? Yep, MACD is still up. It's still above the zero line, right? That red line is our zero line. And so, awesomeness. And we get a nice big move up. Okay, so that's the basic tradable pattern here. Let's look at another one. So as we look for another one, let me see here. I'm going to show you a couple of other situations here. So we're just getting the main pattern down now, and then I'm going to show you how to be a little more precise with it. Actually, let's just use the yellow highlighter. So we have a contraction, Bollinger Band squeeze. Then here we get the Bollinger Bands moving away from each other. It's got to be both. In other words, it can't just be, if we're going to go short here, MACD is going down, but we can't just look at the lower Bollinger Band going down. The upper one has to be going up. So you need both Bollinger Bands moving away from each other, expanding away. Just looking at one is not enough. It's got to be both. Very important. Muy importante. All right. So then if we look at, we go up here. Okay. Bam. Kablambo. There's that wonderful technical analysis term. And so that's saying, okay, we've got momentum. MACD is typically referred to as a momentum indicator. Going down with volatility. So we're combining these two energies of money flow. That's the kind of secret sauce of why we would use two indicators together. Momentum is measured by MACD here, and volatility is measured by the Bollinger Bands. So we've got two energies, uncorrelated energies, that are aligning. And so there you go. Bam, goes down. Cool. Awesome. We love it. We rock and roll. We call our broker and we say, yeah, okay, I'd like to pull out $7 million and put it in real estate or something. Keep the other $10 million in my account. Okay, or maybe it's $7 and $10, whatever it is. So that's the basic setup. All right, now let's talk about exceptions to the rule where you might get messed up, and I don't want you to get messed up, obviously. So now what we got here, let's see, we got your, oh, this is the basic concept here. Actually, let me go back and find a great example. Oh, dang it. Messing around here with my drawing software on my video capture software. All right, so I want to get a really good example for you. All right. There we go. Well, no, let's go all the way back here. I just want to give you a super clear one. Okay, yeah, here we go. Awesome. So now, let's look at this one. And this one does not work. I love to show you things that don't work. By the way, here's another little extra tip for you. If you get a trading book or course or whatever, one of the problems with a lot of education out there is that they only show you the best trade setups. Literally what's called the textbook setups. And that's a huge problem for your learning experience. Because if that's all they show you, and of course they got to show you that so you know, just like I did here, but if that's all they show you, then it's going to program your mind that it always works all the time because your brain is focused on that. If they don't show you setups that don't work, which they should, then it's going to mess with your mind because your mind's not going to get used to that and it's going to say, what? This doesn't work. So it's very important that any educator shows you examples of when it doesn't work and what to look for to potentially avoid those. So here's an example of that. So in this particular case, let's see, we get the Bollinger Bands kind of expanding away from each other here. Okay, they kind of, let's see, where else is another example? That's really, well, actually we got them here too. So the MACD goes down. It's going down, but price does not go down. Right, all this time here, price kind of screwed that up, but anyway, you get the idea. Through this whole time here, price does not go down; it goes sideways. So what the heck? Why is that happening? Why is that happening? Is because the MACD line is, again, the distance between these two moving averages, the 12 and the 26. So just because the MACD line is going down does not mean price should go down. Why? Because it could not have momentum going down, even though it measures momentum. Just because the line's going down doesn't mean momentum is going down. It could just be going back to zero. It could be reverting to zero. So there's actually two scenarios. One, when the MACD goes down, momentum could be going, and it's above zero. Let me clarify that. When MACD is above zero and going down, it could be downward momentum, or it could just be going to zero. In other words, kind of a reversion to the mean situation. And that's what's happening here. That's what's happening here. So that's a little tricky, right? How do you know? Gotta tell you, you don't know for sure. You don't know for sure. So these are not the best trades. In other words, the best trades are not when the MACD is above zero and returning down, because it either could be downward momentum or momentum coming out of the market, in which case then price just goes sideways. Could be either one, and you're not going to know. You could look at price action and try to determine that. That'd be okay. But again, there's no guarantee of either way. So the best signals occur when, there we go, when it happens, see, there we go into the close again. But when it happens and the MACD line is above zero, like there. So here we have a good example. So the MACD line is above zero. The Bollinger Bands are expanding. And we go up. And we catch it as early as possible after this contraction. That's another thing with those other examples. If you notice, we didn't have a real tight squeeze on the Bollinger Bands. But the higher probability is when you're above zero and the MACD is going up. Then there's no reversion to the mean probability there. Okay, that's your high probability trade. So very important to show you both of those. Now, here we have the same thing, Bollinger Band squeeze, Bollinger Band the bands moving away from each other. And this time it goes down. It does work, right? We make money on that trade. But the MACD was above zero. So that's why I say it could be either, you don't know, this one worked out, but your higher probability trade is when it's above zero and it's going up. All right, nice trade, by the way. These are nice. Now, these are not necessarily long or good for long term. This one lasted what? Well, actually, it lasted about 45 minutes, so it's not too bad. Obviously, it's going to also depend on your time frame. This is just a little 2-minute chart. So finally, let's look for one where it's below 0. See, now, well, no, that's at 0. Yeah, so there you go again. Oh, okay, so here we go. So now here we get it where it's below 0. Bollinger Bands move away from each other. MACD's moving up, but it's below 0, so we're not 100% sure if it's going to, if momentum is up or if it's just contraction of volatility. But no, it is a momentum move up, and it goes up very beautifully. Any of this kind of stuff, no, this is nice to just stay out of. So this is also, by the way, this serves another purpose, and that is when to stay out of the market. Sometimes learning when to stay out of the market is just as valuable as when to enter. In fact, maybe more, because we don't want to make money and give it back, make money, give it back, get caught into that whole cycle. So when everything's just hovering around the 0 line, what does that literally mean? It means no momentum and no volatility. And there, therefore, means no money to be made, and therefore that means no trade to be made. So learning how to stay out of a market is very important so you don't give back your winnings. All right, well, there you go, my friends. Hope you found that very helpful. I love working with you guys, and put any comments down below or questions that you might have in the comments. I would love it. Feel free to share this with others. That's one way you can pay back. And also, as always, got my rubber band trade for you as a YouTube viewer. I will share with you one of my complete trade setups with all the rules, the exact entry to the penny, paper, tick, the filters, I mean, everything. This is a complete trade setup, this rubber band trade. It's a reversion to the mean mathematical model, by the way. And I just love it. It's a super high win-loss ratio, which is why I like it so much. So click on the little eye with the circle around it in the top right corner of the video if you're on YouTube. Wherever you're seeing this, I've put the link in the description, whether it's on, well, whatever platform you're looking at. So it's also down there if you'd like to get it that way.